Hello, welcome back to WINFXTRADING YouTube channel. The only channel that can make you rich overnight trading the Forex synthetic market. It's been a long time I upload the content simply because I don't upload content anyhow. I look at how the subscribers and the trading community are passing through some difficult situations like losses and frustrations. Then when I look at that, I consider how to solve such problem. If you look at my videos, like most of the videos are tested, like they're having a very high level of affinity to get more viewers. The reason is because some YouTube users, some Forex trader that come to YouTube to look for solution to their losses or failures, they don't like to hear the truth. What they need is some colorful indicators and sweet talks. But once you are ready to become successful, you must view my video. You must share my video if you really want to help others. So try to subscribe, try to turn on the bell notification so you get notified each time I do a new content. Try to share and like this video so that YouTube push you to a very high level of audience. Okay. So today's topic, we shall be talking about new hidden V's of Volatility 100 Index Millionaire Plus Trading Made Easy. Curvature angle analysis for valid bear bull reversals. You see, why people lose is because they are selling when the market is buying, and they are buying when the market is selling. Also, at times, you will notice that you have a right signal like the market is buying, but you just bought at a price where the market will start reversing or retracing. The same thing happens with sell. So there is now a notion of buying at the right time and buying at the wrong time, even though there is buy signal. The same thing happens to sell. So if you're able to solve such problem whereby you buy at the right time and not buying at the wrong time, like during a buy condition, during a buy season, during a bull market, we know we're supposed to buy. But if you buy at the wrong price, at the wrong time, that is the cause of the losses. Then if you are selling and you sell at the wrong time or at the wrong price, that's the cause of losses. You see, price and time, there are two variables there are two physical variables that actually governs the Forex or synthetic market, but the issue of psychology, sentiment, the issue of hidden or invisible market reversals. There are also variables that actually controls the Forex synthetic market, and all of these can work against you. They can work for you. That's why you should enroll for my VIP courses and signal channel so that you'll be able to take advantage of the made for you services. Like, it's already made. You don't need to struggle to produce signal, or you don't need to struggle to go to the internet to look for resources to learn the Forex market. We have a well coordinated and a well organize courses that will actually skyrocket your trading to the next millionaire level. So I don't want to talk much about all these products and services, but you need to change your life, take advantage of others, leverage the effort of experts. We also have robots that are actually making people huge money. It depends on what you want. Okay, this robot never lose. You can buy this robot today. It's for Volatility 75 index. That is where it works perfectly. You can get it and your life will remain financially free. Okay, so let's dive into this video. I don't have much script, but I'm going to make everything clear on the chart. So let's go to the chart so that we start the analysis. Okay, make sure the daily time frame is the time frame you are using, because the daily time frame contains the H4, contains the H1, contains the M30 and all the time frames lower. So it shows us the universal truth about the market in the medium term and short term. Actually, this topic is a kind of course that will help you to go long in the Volatility 100 index, like to stay long, to trade long time. So we can approximate that daily time frame will give us a long-term view of the market, yes, but the short and medium term is actually also visible here. In other words, you can stay 50% of your presumed or your assumed long-term view of the market, just 50%, because you don't actually need to trust the market since you made the analysis on the daily time frame. Remember, it's not a weekly time frame, neither is it a monthly time frame. So let us start the analysis. Remember, this topic is very necessary to I want to explain this topic before we dive into the analysis again. We have key points here: curvature, angle analysis. One of the key points here is curvature, angle analysis, and another one is bearable reversal. Now, what is a curvature? That's the problem. Now, what is a curvature? In science, in the mathematical field, a curvature is just a kind of sharp bending. Now, that sharp bending will lead to another direction. Whenever you see a sharp bending, let's say on a road, on a highway, and you see a sharp bending, that sharp bending must lead to another direction. So when we say curvature, we are trying to talk about a phenomenon whereby the current market direction is actually changing with a definite or a visible angle of curvature. It must have a visible angle of curvature. So let's go into the analysis so that you will see that these angles are characteristic of bearable market reversal. Like they actually tells you that this market is gonna reverse. It's not a function of end screen theory or other theories that I have developed in my channel, but is actually a function of angle of curvature. This is entirely a different approach to trading. Okay, so you see, this is the daily time frame. This is the daily time frame. Now, I'm going to tell you what I mean here, because it's not easy to know when market is going to reverse in the long term. It's not easy. It's not easy. But with this course, with this video course, you can actually understand it. Though it's a free content, remember, It's a free content. You don't need to know everything from here because it's a free content, but I will go I will try as much possible to bring out the idea from this. Then if you need the premium course, check down the description of this video. You see the cost list starting rolling. Okay, that's good. Now you see, we start with what we call the current price action in the daily time frame. Let's say I'm going to use this market pull up from here all the way to here. I get in it. It started from somewhere here. There's a point there and reaches a maximum. It reaches a maximum price point. So that's what we call point theory. I'm going to bring the notion of point theory to explain this. You know, a lot of people actually trade like they trade different type of points, and that what make them blow their account. They trade different type of point. A valid application of point theory will actually help you to become successful trader. You know, those that actually have the notion of the understand point theory will buy here. When they buy here, they are going to believe that the price will never come back to this point at infinity of time. Like after many, let's say years, after many months, the price will never return back here. It will only return back maybe when you must have made huge profits. Now, this type of belief is what point theory trader use. Are you getting it? So you have to track the locus of the current price action, like the current path or the current direction in the market before the new curvature starts creating. You have to map. You need 2 points. So the first point should be where the price left, and then the next point should be the maximum point. Then you draw it. That is the locus of the price. You draw it. Now, next, when you notice that a new price action has created that is actually in opposite direction to the current one, then what you need to do is what we call swing point analysis, differential swing point analysis. Once you notice that the swing point, there is a reverse swing point creating at differential levels. I'm going to make this thing clear. People should know that what I'm doing here is technical and scientific. And remember, science doesn't lie. No matter how they code the volatility market, we still have genius. We still have aliens that can make things happen. So that's what is happening here, right here. I could be the alien. This video could be the alien. So be careful and watch it to the end. So here, you see, I said carry out a differential point analysis on the reverse path or the reverse direction. Now, you see, this is the maximum point. Then the next, how am I going to put this? A critical point or a swing point. This is the maximum swing point. Then there is a new swing point that creates here. But if you compare the 2 points, there is a differential. they are not at the same level. There is potential difference. Remember, I think maybe I have not created the content, but there is this potential theory in the market. I will actually check out. If I haven't uploaded the content, I will upload it soon. So, subject to potential theory, this point is at a lower potential with respect to this point. Now, those that read electrical engineering, in physics world, like in physics or electrical engineering, you discover that when 2 points are not at the same level, there is pressure. And the pressure actually flows from the high point to the low point. Now, if this point here is lower than this point, whatever force, that force that made this point to come to this level instead of going higher, that force is the force you are going to follow, and that is bearish force. So bears are the one that made this point to be lower than this maximum point. So this is our first point of interest, or our first reverse point of interest. Then you are waiting for another one that will actually respect this point of interest, and that this is another point. So here, when you start seeing price finding it difficult to break this third point, because we have the maximum swing point which happened during the previous current direction. Then we have the first swing point that is at a potential with the maximum swing point on the current direction. And then we are now waiting on a third swing that will be at a potential to the second reverse swing here. Now, and that is what happened. You see, each time price came here, it dropped. Finally, price did not break it. Then we are going to be selling on this strong resistance part. Maybe you are going to be selling on this bearish candle, because you know that this zone cannot be broken. The price cannot pass through this zone to go up. So you can be selling on this part of least resistance. You can be selling. You see, imagine you follow this Curvature strategy. You should have made, if you sold here, you should have got over 7,000 pip. Now, remember I made mention of Curvature angle. What does Curvature angle mean? Now, we are going to see if we can get a line that will intersect with the current price action direction before you start doing the Curvature analysis. So let's try. We are going to use the 2 point of interest on the reverse part that is created, which is also subject to potential theories. We see we notice this point here is the first one. This is the first point, and this is the second point. Then the maximum point on the current direction can also be used, that is making it 3. So we can use either 2 points or the 3 point to draw the line. So, or you can also you use the 3 point or any of the 2. It can work. Just permute any of the 2. So here we start from the maximum and then we stretch. Okay, see what you're going to do. Start from the second point and then connect it to the third point and then stretch. Then when you stretch, then stretch both sides of the line to intersect with the current direction line, you will not force it. You don't need to force it to intersect. You just stretch it naturally and see if it will intersect. Once it intersects, see the point that will help us to get this locus, this second and this third point. The maximum point in the current part is not needed here. Just I said 3 or 2. Just avoid that so that our analysis will be easier to understand. You need to use to track the locus, like we use this and then we use this. Like you put this here, then you stretch. It's already stretched on. It's stretched already. Make sure that it's touching those points. Make sure it's touching those points. So you see this angle. This is what we call angle of curvature. The angle between these two lines is the angle of curvature. So what it is that this angle of curvature exists because we have seen it after drawing this. It does exist. And then because it does exist, what you need to consider is this angle that creates between these 2 points does exist. So when it exists, then the trend is changing. Then what we confirm that the trend is changing is because of potential difference here. The direction of the potential difference is what is going to tell you that the price is changing. Then how do you know the direction of potential difference? How do you know the direction? The direction is, if you look at those potential points, look at this is a potential point. Let me map all the potential points. It's just 2. We just need 2 potential points for we to start looking for entries. Okay, so if this is a high point and this is a low point, now potential difference is the difference between the current point you are standing on and the previous point. So this current point here on the reverse part that is creating minus this point, you will notice that here this point is a low point and this is a high point. So a low point minus a high point will be a negative potential difference. Now because it's negative, that negative shows bearish direction or downtrend, or the market has actually changed direction. The scope of this course is elaborate, but I'm going to be ending this video in a while because of it's a free content. I don't need to go deep into technical analysis, into the mathematical models that prove that this is real. But believe my words, whatever I said here actually work, and that will help you to enter the market. Actually you can be entering this market on this third swing. Whenever price came back to this zone, you will enter. You place your stop loss above the zone. Yes, then you make your sell entry. Your take profit will be at a very far price because you believe that this market is gonna sell. You believe that this is a bear market. So you see how the bull market have reversed into a bear market. You see. Now I will not be talking about the opposite, where the bear market reverse into the bull market. I will not be talking that because I want you people to be very serious. If I show you everything on a free content, then you will not be ready to learn, because there is difference between learning something free and learning something that is premium. In a premium, you get a lifestyle, not just learning barbers, words, or not just learning the technical analysis and all of that. You get a lifestyle that actually help you succeed in trading, because if you don't have that lifestyle, it will not be too long you collapse. So I will not talk about the bull market. I'll be ending this video. This is almost 25 minutes video. It's taking much time. Okay, but at least you can notice another bear market happening in this market. Let's do the analysis. This is another bear market, like a bull market is changing into a bear market. Based on point theory, the market starts from here and stretch all the way to here. Now, we are having this potential difference here. There is a point here. There is a point here. There is a swing there. The market came there and swing, and now there's another one here that is happening. So this market is going to sell massively. Believe me, you will now know that what I'm teaching is real. It's going to sell all the way down here, because based on point theory, whenever price leaves a point and starts following the potential difference directions, is going to retest previous potential point where it left in history, like where the price left before. If the price reverse towards that point, there is high tendency is going to get to that point or near it. So this is what is going to happen to Volatility 100 index. Volatility 100 index, therefore, is likely going to hit a $10,000 in price, like $10,000 in price or 10,000 in price. Okay, so that's good. Thank you for watching. I'll be ending this video. Try to join my VIP, because this is idle. You might watch this video and try to practice it, but you are not getting it right. So it's not my fault for you. It's left for you to take the advantage of the VIP signal service, and then make sure you enroll for my courses, because all these free content are free. They are not the lifestyle. There is a way I teach people, they become experts, and it's not the free content that will make you expert. Okay, so thank you and bye for now.
Give me all you've got if you're prepared to break the silence. I'll be out in the sunshine, running beside the lions. I've been feeling down, but I've been looking up. All you've got if you're prepared to break